Hi there. This is a re-record of the seminar that we presented in Tauranga in February of 2024 on de-risking your construction business. This is the short version of the presentation, so it's going to take a little under 25 minutes to run through, and it's just going to focus on my section there, which is talking about the growth opportunities and the trends that exist even within a market that might be struggling or declining. And if you can take advantage of those opportunities and trends, you can grow even within a market that's otherwise experiencing some challenge. We'll put a link to Tony's speech notes and we'll upload his presentation separately, so you'll be able to see that as well. And that's a really valuable talk from someone very experienced in the construction industry, talking about all of the factors affecting what's probably going to be quite a challenging year for construction over 2024, with some green shoots towards the end of the year, but also talking about how you can take advantage of or act proactively around understanding all of those challenges and then implementing some change and some plans and as I said, being proactive so that you come out the back of this stronger. So the other part that I'm going to talk about is risk financing, which is a concept around how you can identify, quantify, and then treat risk within your business, take care of all of that threat and uncertainty so that you can really focus on the good stuff, the opportunities to grow, reduce stress, and just make sure you've got a plan for anything so that nothing unforeseen is going to come along and affect the business financially or otherwise. So let's get stuck in. Just before I splice in Tony's piece, give you a few headlines on Builtin. We specialise in the construction industry. That's all we do, and that's all we work for. We've been doing that for 20 years. Headquartered in Tauranga, we've got 10 staff, over 2,000 customers around the country, ranging from sole traders up to customers in excess of 20 million, right across the spectrum from residential renovations all the way through to large commercial jobs, solar farms, and the like. We're a member of Steadfast, which is Australia's largest insurance broker network, which gives us strength and scale, access to global markets, and negotiating strength and all that kind of thing, all the while being a boutique broker that's specialised in construction and really focused on customer service. So our mission is to help construction professionals manage their risk by being experts that are responsive and easy to deal with. And we've got a number of values which include the ones you can see on the screen here. We really care about our customers. You can rely on us because we do what we'll say we'll do. We specialise and look after construction clients, and that's not just around insurance, but it's also about advice and education on an ongoing basis about risk and the ins and outs of insurance and other aspects of risk for construction. We're real people. We're a family-run business. We've got a family vibe, but we give that expert service with a personal touch. And we go the extra mile to find solutions for customers. We offer a full range of services from a risk management perspective. So that's assessment and advice, building insurance programs, arranging contractors' bonds, performance bonds, retention bonds. Obviously, claim advocacy is a key one when something hits the fan, and all the way through to business continuity planning and making sure your business is set up to manage those unforeseen events so you can get back on the tools or get back to work quickly. All right, so for my piece, I'm going to run through some slides here, take about 20 minutes, and starting with just some of the trends that you'll still see in the market, even in a challenging market which might be declining. There's always pockets of growth and opportunity, and if you can take advantage of those, again, you can grow even in a declining or challenging market. So here's some headlines on what some of those might be. Firstly, green buildings. Tony touched on it in his presentation, and it was actually a source of good conversation at the seminar on Tuesday around this area and the growth that we are seeing right across globally, but also the interest in it, not only from, as it says here, CEOs and companies looking to decarbonise, meet targets, become more energy efficient, but also demand from customers and demand from the younger generations coming through wanting to work in workspaces and for companies that have this front of mind. There's also regulation that's driving the sustainability sort of mandate and demand. And if you own buildings that are more sustainable or more green than others, you are attracting a premium in terms of your rental rates. So it's an area that you could focus in and generate, sort of a differential position in the market. Medium density housing is an ongoing area of growth and demand, obviously particularly in cities, and local plans, local regulations are enabling that to make it easier. And so that's an area, again, that you could specialize in and see differential growth. Accessibility is a big one. So there's more than 1 million people in New Zealand reported with some form of disability. And there is legal requirements and building standards that will require certain accessibility features in both commercial, government, and potentially also residential buildings. So with an aging population, that trend is only going to increase. The demand for those, whether it's a retrofit or into a new design, those kind of features. Tiny homes and modular, Tony touched on it, but again, it's exploding in popularity as well from a demand perspective, and that's across a broad demographic. So you've got young people or people who are first-time home buyers wanting something affordable. You've also got retirees looking to downsize and have something a bit more manageable. You've got the off-gridders and the environmentally friendly people. You've got people who are looking for minor dwellings for larger families. So lots of different ways in which this is growing in popularity. And councils and government are making it easier for these types of builds to be facilitated and to meet consent conditions and compliance, etc. And lastly, around disaster recovery and resilience. So obviously we are prone to that in New Zealand more than almost any other country in the world. And it's something that increasingly we'll see a focus on as climate change really does start to take effect. And insurers are seeing the effects of that with the volume of weather-related claims. And obviously we've got earthquake risk and other things as well. So innovations in that space, specialization and remediation and repair of flood damage, earthquake damage, in any kind of resilience or prevention and durability services around construction are going to be increasingly in demand and an area that you could specialize in. And that's essentially the message. There are always areas of growth within any market, even if that market is stable or declining through a cycle. So how can you position yourself and market your business to take advantage of those particular pockets of growth overall? So that's part one of my piece, and again, it's a positive message off the back of Tony's scene setting, and again, it talks of what we're trying to get across here is if you understand the challenges in the market, you are better placed to be able to respond, deal with them, and get ahead of the game. So moving on to part two, what is risk financing? And it's a concept that is going to help you manage the threat side of your business so that you can focus on the opportunities, the growth, and the good stuff, really. So risk financing is about determining how an organization will pay for loss events in the most cost-effective and least costly way possible. So if there's going to be something that's going to cost the business money, whether that's a natural disaster or a cyber attack or a customer going bust, having a bad debt, what are the options that you can take in advance to mean that if that happens, you are managing it, mitigating it, avoiding it in the most cost-effective way possible. And part of the reason that we advocate for this approach is that if there's uncertainty because you have a bunch of risks, you're not sure what they are, and you certainly haven't quantified them, then it can affect your ability to achieve your objectives. So your growth objectives, if a loss event came along, it's going to potentially have an effect on profitability. So the more that you can put a cost on risk, then the easier it is to identify, manage those risks, and then eliminate that uncertainty from your business. And also eliminating threats leaves more room for opportunities, as I've alluded to. So if you can manage that side of the business, then you've got all you've got then is the upside to focus on, all the growth opportunities, because the risk side is taken care of. And putting this in context from an insurance perspective, insurers have paid out in claims over the last 5 years double what they paid in the 5 previous years. So that's through catastrophe events, climate-related events, weather-related events, earthquakes as well. But even just on a general basis, the frequency and severity of those events is incurring more and more and more cost, which means that insurance is becoming less cost-effective as a means to mitigate risk overall. So you're seeing reduced limits and reduced coverage, reduced capacity from insurers globally. They're less willing to insure certain types of things in certain markets, which is having an effect on excesses and of course, increased premiums. So you can't get as much coverage. It's going to cost you more, and you're going to have higher excesses and things as well. So that's just the reality of the insurance market in this sort of in this environment. And another concept that we talk about is just appreciating, I guess, that the risk transfer piece, which is your insurance premiums, isn't the true cost of risk. There's a whole bunch of other things you're doing that add up to the cost of risk to your business. So things that you're self-insuring, assets that you might not have insured, for example, the excess that you pay on certain claims, any liabilities you might have that are uninsurable, so particularly commercial contract related losses or WorkSafe fines is a good example. What are you investing in risk mitigation? So that could be training of staff, it could be legal costs or costs you spend on written contracts, fees for joining associations that advocate for you and provide services, those consulting fees like legal advisors, accounting advisors, risk advisors, any software that you use to analyze your business from a financial or otherwise, business coaching, asset valuation expenses, and of course the opportunity cost of not taking advantage of opportunities is also a cost of risk. So not investing in areas of the business that you could, or failing to innovate in other areas is also potentially a cost of risk. So we're looking to understand what is the true cost of risk to your business and identifying and itemizing those areas. And risk financing is a process. It may seem daunting, it may seem complicated, but if you go through the steps, then you can build a plan to, as it shows here, identify all those risks, analyze the cost of them, and then you can devise a treatment plan for each of those risks. And if they occur, then you've got the plan in place, or you've got a mitigation to really reduce the likelihood of them happening in the first place. So step one of that process is risk identification, where you categorize the various hazards that a business might face. And this is an example of the categories that we use. And within each of these categories, there's a multitude of different individual risks. And this structure just helps us work through, work with a client, work through a business to say, is this risk applicable, yes or no? And then we can move on to the next stage. So as I said, really just a process. Step two is the analysis. So once you've identified all the risks, then you can go through and quantify them to the best of your and our ability. So here's just an example of that natural risk category. You may have a risk of severe storm. So then the next step is, well, what's the likelihood of that risk? Is it very unlikely, like a 1 in 100 year event? Or is it very likely, like something that would happen multiple times a year, like potentially a bad debt or key staff member leaving or something else within the business, and a customer complaint perhaps? So then you know sort of roughly how frequently those things are likely to happen. And then if and when they do happen, what's the likely loss of value? So is it an expensive event? Well, if a building burns down, that's extremely expensive. If we have a vehicle accident, well, relatively speaking, not so expensive. And by going through that process, making a calculation, you can work out the annual cost of each of these events, which is how we quantify the risk and what allows us to then say, well, essentially anything we're doing to mitigate that loss on an annual basis that costs less than that, the business is winning. You can draw some fancy graphs to sort of illustrate and visualize it. And then part three is the risk treatment. So that's essentially saying, well, now we know the cost of all these risks, then we can devise the plan to either transfer it which is pay a premium to an insurer to take that risk, the cost of that risk off our hands. To mitigate it by putting in place plans, procedures, systems, processes. We could eliminate it and just choose not to do that activity. So there's various different strategies that we can put in place to treat those risks. So here's an example. Let's say bad debt is a risk, one of the things that might keep you up at night and potentially affect your cash flow. Well, history shows in our business that a significant bad debt comes along once in every 5 years, which might be upward of a $50,000 loss. And especially in the market that we're looking at it now, with increased liquidations, but a strain on construction businesses and on customers, there's potential for more of this to happen. So in this coming period, we might see more of this, and we might see greater loss values. But let's say that's the picture. So $50,000 event once every 5 years, we've got an annualized value then of $10,000 a year. So what's our risk strategy to mitigate that particular the risk of a bad debt? Well, we can transfer it. We could have insurance called trade credit to again transfer the cost of bad debt, or we could have a treatment plan, which is we're really good at monitoring our credit. We certainly don't do work for customers that aren't paying. Perhaps we get paid in advance. Good luck. Or when we subscribe to debt management or invoice finance or some other mechanism by which we can really mitigate the potential for a bad debt to accrue. And then move on to the next one. So that was the process in a nutshell. And the outcome of that as well is something called a business continuity plan. So that's about crisis management. And this is a picture from Tauranga, where just this week we had a big hole open up in State Highway, caused chaos from a traffic perspective, and businesses were advised to implement their business continuity plan, get staff to work from home if they could, etc. Now, the likelihood of the majority of businesses in the area having a business continuity plan in respect of an event like this was extremely unlikely, but it put a spotlight on the fact that this kind of unforeseen event can happen. And whilst this might be extremely rare, when you add it to the 400 other things that are extremely rare that might happen, like a pandemic, then you start to realize that it's valuable to have a plan for these very unlikely and unforeseen or unplanned events. And if you have that plan, it allows you to get back up and running quickly and avoid a lot of the catastrophe or the pain or the loss that you might suffer by not having that plan in advance. So that's the obvious concept. It's just actually getting there is usually the tricky thing. So as I mentioned, there's many different crises, big and small, that may require a response, from the big stuff like natural disasters, potentially cyber attacks, all the way down to customer complaint, customer not paying your bill, staff getting into trouble, something reputational, you getting stuck overseas and not being able to manage the business back home. So anything like that could constitute an event that could trigger a business continuity response. And those responses can vary in degree as well. So there could be a major event and business can't continue. Well, how do we deal with that? To something minor, like you've got more staff off sick than you anticipated, and so jobs aren't getting done, and so there's a delay, or council is delaying the issue of consents, and so there's a cash flow knock on from that. So what's your backup plan? Or perhaps there's a supply chain related issue. You're overly reliant on one supplier. We've had this as well, and they have to put a stop on or an allocation, or all of a sudden stuff's not getting in from China. How do you manage that side of it? And being able to have a plan in advance. So instead of ringing all the other merchants that day and trying to get an account with them and them telling you to bugger off, how do you plan ahead for that kind of thing? So the good news is, because this can be quite daunting, and we wouldn't expect anybody to try and build it or manage it without support, is you don't have to start from scratch. All our clients operate within the construction industry, so we can streamline this process. We can expedite the risk assessment. We already know 80% of the risks that general business faces, construction businesses in particular, will face, and so we're not starting from scratch. What we would advocate is that you would take on essentially the services of what we call a virtual risk advisor. So that's someone that works for you, but is in our business essentially. So it's like having a professional that you can phone up to say, hey, look, we're entering this new contract, or we've got this particular change to our business. What are the risk implications? And we can provide you with advice on how to manage that from an insurance perspective, all the way through to systems, processes, and procedures. And in this context, help you build that risk financing, risk assessment, and business continuity plan. You would subscribe to a specialized portal which works through the process of building the plan. So we work with you to identify all the risks, quantify all the risks, build a treatment plan, and that includes a whole bunch of things you're already doing in your business, but we're just putting them together into a place. And by doing that, it'll help you identify all the gaps, the things that you hadn't thought about that, big or small, might need a thought, sort of a preventative approach, or some sort of plan put in place. Useful portal because you can store critical documents and information in there. So again, if something happens to the business, someone else can jump in here, get access to details they'll need to pay the bills or to make sure the business can continue. So the benefits of this approach is, of course, you can react more quickly to a crisis, which is beneficial because you can get back on your feet faster, certainly faster than your competition. It makes you more attractive as a construction partner as well. So for principals or main contractors, if they can see in your tender submission that you've thought through all the stuff, that you've got a business continuity plan, that if anything comes along, it's not going to materially affect the project, which is what they're concerned about. So it makes you more attractive as a tender partner, as a construction partner. And in the same way, you become more appealing to investors and buyers because they don't want surprises. They don't want something to come out of left field and affect their investment. So if you can demonstrate that you've thought all this stuff through, that everything's taken care of, all the mitigations are in place, there's no surprises, makes you a much more attractive target for investors and buyers. And of course, it means that life is less stressful because none of those unknowns are there to keep you awake at night. There's none of that uncertainty. You've thought through everything. You've got a plan for everything, which is always a good thing. So in summary, 2024 will be a challenging year. We do expect green shoots at the back end, but the first 6 months is going to be pretty tough for a lot of businesses in this sector. But within a challenging market, there are always areas of opportunity, trends for growth. So if you can take advantage of those, be proactive, be on the ball, listen to what Tony has had to say about how you can come out stronger through this process and manage through this process, then you'll be in a good place. So as part of that, get your house in order around identifying, quantifying, manage the threats and risks to your business. And just remember, it's a step-by-step process that we can help you walk through to come out the other end in a stronger position. So that's it. Thanks very much for those of you who have listened today. We're obviously really happy to talk more about this, happy to set up a meeting, talk through this in more detail to any other stakeholders within the business, and see if we can assist you. Thanks, guys.